Alright everyone, so welcome to another video. In this video I will be talking about the technical stuff that goes into making a weekly and daily bias / forecast. Pay very close attention because it is going to be fairly lengthy and it's very important that you make note of everything I say, okay? So without further ado, let's begin. Okay, so before you begin watching this entire video, I need you to watch all my previous content, especially all my stuff on daily bias, because it all goes hand in hand. And another thing, everything that I teach you, you can also use it or take some of these things out to make your own strategy for finding your weekly bias or daily bias or session bias, all right? You don't have to use every single thing that I'm teaching you. You could just take all the information and see what fits best for you or what you think fits best for your trading strategy. All right, so let's move on. All right, so these are the current time frames I use to make both my weekly and daily bias. You don't have to use these very specific time frames, but me personally, when I've been doing my weekly forecast and my daily bias session for my session, these are typically the time frames that I have noticed I have been sticking to. There's not really a particular reason why I have like a 6 hour and 8 hour. It's just personally, that's what I've seen fits best for me. Okay, so just wanted to clear that out. Okay, so this is very important. Overall market direction. Always keep in mind that the use of the monthly, weekly, and even daily charts are used for determining the overall market direction. Lower time frames under the daily guide the intraday / daily trend. So pretty obvious, right? Here is an example of the weekly. I have an order block marked out and a weekly fair value gap. Just very simple PDRAs, right? And here on the 4 hour, I will be using it as a way to find my bias for the session or for the day. And as you can tell from the dashed lines, these just represent each trading day. So pretty obvious, right? Marking up my zones. If it's bullish, I'm looking for buys. If it's bearish, I'm looking for sells, so on and so forth. And you can use the weekly time frame or the weekly PD arrays as a possible potential for a draw on liquidity, right? Or like a magnet for liquidity. Just easier that way, I guess. So yeah, pretty easy, pretty simple. All right, let's move on. All right, so the next very important part of this video is the law of cause and effect. And why is this important? So the law of cause and effect is a principle often used in various fields, including trading and economics. It basically states that for every effect, outcome or result, there is a cause, a reason or action that leads to it. This means that events or changes in a system don't happen randomly. There's always something that triggers them. In trading, the law of cause and effect works like this. Cause. This is the buildup of things like market sentiment, news, or large trades that can lead to future price move. For example, if a lot of buy orders are stacking up, that's the cause. The effect is the result of those causes, like a sharp price increase or breakout in a certain direction. If enough buy orders build up, the price will eventually jump up. That's the effect. Traders who understand this look for the causes, like big players buying or key news events, to predict the effect, how the price will move. This helps them make smarter moves by acting before the market fully reacts. In simple terms, it's about recognizing what's going to drive the price so you can get ahead of the trend. Now, we'll be going over an example of how you can use this in real-time markups, but we'll get into that in a little later. For now, let's move on. All right, so building up on the previous slide, cause and effect plus IRL to ERL. What caused price to take out external range liquidity? Well, as you can see, price was already in an uptrend and had reacted off of the bullish order block, which affected price to go towards ERL to take it out. Pretty simple, right? That is how I usually view the markets when it comes to my daily bias or weekly bias. It's just very simple. That's like the foundation, and then from there on I build it up on a few other things. All right, but it's very, very simple. All right, just try the concept itself on a chart and see if you can sort of use the same method. What caused price to do this? What was the effect of it? So on and so forth. All right, now let's move on. Now, the next thing that I consider to be very important is market fundamentals, or really news. When the market is indecisive, look for confirmation from multiple sources. If both market fundamentals and technical price action point in the same direction, it increases the likelihood that the trend will continue. So let's check this out real quick. We have a type 1 breakup structure, and if you don't know what that means, you need to look at my intermediate to advanced market structure video. I'll link it down in the description below. So we have a type 1 breakup structure, and then what do we have here? Retracement down to this rejection block, comes back up, failed breakup structure, and we also have a weekly fair value gap. What does price do? Comes down, taps into the daily order block. Now, without market fundamentals, we might be a little indecisive as to where price will be headed, right? It'll be pretty hard to say, okay, well, where would price head these next few days? What is the more likely outcome? We have some pretty good reasons as to why a price should move up, and we also have good reasons as to why price should move down. But with market fundamentals and news, we could have erred on the side of the market being bearish and could have caught this move, right? So if you're ever in a moment of confusion or dancing in between, okay, should I be looking for longs? Should I be looking for sells? What should be my bias for the week and even for the day? If you're struggling, the first thing I would actually recommend is just don't trade that asset. Move on to another asset that has more of a clear direction. But if you really, for some reason want to trade the asset that you're looking at, then add market fundamentals. That way you can have at least one extra confluence that says, you know what, we should be looking for sells or we should be looking for buys. And in this case, we look for sells, hence why price ended up going down. All right, so all concepts work best on the daily, weekly, and monthly time frame. So things like breakaway gaps, order blocks, fair value gaps, Elliott wave patterns, displacement, and many more carry more significance for forming a weekly bias compared to lower time frames below the daily chart. So literally, guys, any idea, any concept, it could be a unicorn model, or it could be an engulfing candle entry. I don't care, whatever concept it is that you have in your mind, it works best from the daily and up. All right, if you find a concept that you like and you want to use it as part of your daily or weekly forecast, you can rely on that concept a little bit more since you are using higher time frames, because each candle now has more data, and that means it's more reliable. So for instance, an example is like a breakout. On the higher time frame, breakouts carry more significance because you're using a lot more data, and there's usually a little bit of fundamentals baked into each of these candles, hence why price ended up going up. But if I were to go on a lower time frame, sure, price might temporarily break it out of the structure, but what will it do? It'll probably either reaccumulate or it'll probably reverse quickly. In this case, price broke out, went down for a little bit, accumulated a little bit, and then reversed, right? So I'm not saying that a breakout strategy wouldn't work on a lower time frame. All I'm saying is it wouldn't be as effective as it would be as if you were trading on like a daily chart or a weekly chart. That's all I'm saying. Just be more careful and maybe use a little bit more confluences. Also, I should have added this on the previous slide, but I have a secret little strategy for how to use news for part of your bias. But if you want to see that part or that little extra tip, I'm going to leave it in the Discord, because I'm afraid that people aren't going to use it responsibly and they're going to start blaming me for it. So I just want to mitigate that. And if people have questions on it, they could just hit me up a lot quicker on the Discord. Okay, so join the Discord, check it out, and I'm pretty sure you'll be very surprised at how cool it works. All right, moving on. Okay, so your type 2 structure must be in line with your type 1 structure. Your type 1 structure is the main overall structure and can be traded along with the type 2 structure, which represents the smaller internal structure that forms between the main swing points of the type 1 structure. You also have to keep this in mind when trading from IRL to ERL. Ideally, both the daily and weekly time frames should align before entering a trade. Remember, this is ideally, especially when trading continuation of the trade or trend. This alignment needs to happen at the right time or in the same key levels to increase the chances of success. So here I have an example of what type 1 structure looks like and what type 2 structure looks like. Here you would be trading along the same trend. Ideally, if you're going to enter for a long, you want to make sure your type 2 structure will align with your type 1 structure. So as you can see, price retraced down here, it retraced down here, and then you would have been looking for your buy setups under this area. All right, so I actually have another little example that might actually show you guys a little bit better what I'm talking about. Okay, so here you can see it's that same example that I showed you on the previous slide, but now we're zoomed in on the 1 hour time frame. So if I were to go from internal resting liquidity to external resting liquidity, I would ideally want it to line up with my higher time frame or my weekly or daily time frame, and make sure that price retraces into those key levels. In this case, price retraced down into that daily fair value gap. I looked for some kind of candlestick or momentum that says, hey, it's time to go back up. I found it right here, and then I entered, stop loss under here, and traded into an area of liquidity, or in this case, an order block, which could also be known or seen as a type of liquidity. Again, you should look at my intermediate to advanced market structure video. And also, you could scale on a much lower time frame if you wanted to and keep going from IRL to ERL. So for instance, you could have zoomed down on a lower time frame and maybe found like an order block or something down here, and enter on the lower time frame and maybe, you know, targeted this little area of liquidity here. Same thing here, maybe you could have scaled into an order block on the lower time frame here, and then targeted this, the same area, right, the same order block on the 1 hour time frame, so on and so forth, right? You could just keep going from IRL to ERL, IRL to ERL. Very simple, okay, just like that. All right, so for this part of the presentation, it's very important that you take note on how I use these methods to mark up my charts. You don't have to use every single one of them, but it is very important that you pay close attention. They're just basically suggestions that you could use, right? Because I use them. But there's many ways. There's many other ways that you can use them, many other methods. These are just the ways that I prefer to use them, the ways that have given me success and other traders success. All right, so let's begin. All right, so first one is rejection blocks. So rejection blocks are like spots on the chart where the price gets a firm no and changes direction. These zones can lead to rapid and forceful moves in the opposite direction. I usually only use these types of zones for my weekly bias, but very rarely will I use it for my daily bias. Now usually with a rejection block, you'll see price tap into it and only leave a wick behind. Usually that is the best way to use them, but in this case I still think that price rejected off it fairly quickly, because as soon as this bearish candle closed, a bullish one opened and closed bullish, and we only had bullish movement after that. That's why I consider it a rejection block. All right, so the next one is order blocks and supply and demand. So these are versatile techniques that help identify whether the market will revisit a specific area or not. And they're also excellent for marking up market structure across any time frame. So I'm pretty sure you and I can agree that that is very much true. And if you haven't seen my supply and demand or order block video, you must look at it. It is a must. I'll link it down in the description below. Another thing too is that order blocks also a good way to mark up just market structure in general, right? So you can use it as a way of finding if market structure is continuously bullish or continuously bearish, and if price will at some point retrace into that specific area. But as you can see, price shouldn't retrace into this area because it was already tapped into, right? Pretty cool. All right, so the next thing is fair value gaps. So fair value gaps are extremely vital when it comes to both daily and weekly bias, since the market is constantly retracing into them, especially if you have fractal highs and lows that over them. As you can see, this little fractal high was overlapping this fair value gap, which makes it even more high probability. And from what you can see here, this fair value gap was already constantly tapped into and retraced into one more time, hence giving me another reason why price shouldn't go past this area. Okay, next is the Fibonacci tool. So this tool is obviously great for telling if price is headed or already is in a premium or discounted area, which can also give our POIs more validity. Now, I won't always 100% use the fib tool, and you can use any fib tool you want, but it can be necessary sometimes when, you know, marking on my market structure or seeing if a fair value gap or just some form of point of interest lines up with it, just for a little bit more confirmation. But you don't absolutely 100% need it, but it is nice to use every now and then. And the finished outlook would be something like this, all right? type 1 structure and your type 2 structure, rejection block, the order block for value gap, all that good stuff. Now, here are some other confluences that you can use as part of your daily or weekly bias, right? So the first one is a unicorn model. Now, if you're not familiar with a unicorn model, all that is a breaker block and for value gap overlapping. And as you can see here, there was a breaker block right here for value gap near it. They were overlapping, price retraced into it, and then pushed back up into external range liquidity. Pretty simple, y'all, nothing crazy. The next one would be market maker models. Now, I would highly recommend you watch my video on market maker models. It's a pretty in-depth video on this, but definitely very much worth it. I would highly recommend that you guys check it out just so you could better understand it. But I would definitely say it has helped out a lot when it comes to both weekly and daily forecasts. All right, so check it out. All right, so Elliott wave, that's right. Now, I actually borrowed this from a previous video that I made on Elliott wave, and from what you guys can see, I have my entire time frame Elliott wave marked up and my corrective pattern. So ABC, what did price do? Retracing to this Fibonacci level, and price ended up heading down, right? So if you guys are trading Elliott wave and you guys see a pattern like this, then you would be looking for bearish setups. Pretty easy, pretty simple, right? Now the next one would be weekly bias, but more of a simple version plus AMD and power of 3. I also have a video on this, so definitely check it out. So I'm not sure if you guys remember, which you should, because I'm telling you should watch my previous daily bias video, but it's really simple. All you have to do is mark up the previous day, the high and the lowest point of the day, and then as long as price closed below the body wicks, then the next candle should also follow the same. Now here, this is actually pretty new that I've started to notice, especially on the higher time frames, is if price, for instance, were to close only below the previous day close, in this case we have this bearish candle closing before the previous day close, you still have a possibility of price being bearish the next day, or bullish depending on what you're looking at, right? But in this case it would be bearish, and it was. Now it increases even more if the price closes the same color candle. So if you have a close of the candle on the previous day close plus it's the same type of candle, then you're still good to look for sell setups and vice versa, but that doesn't guarantee it 100%, although nothing in trading is guaranteed 100%. Now as an example here, closed above the previous day open, which is the first sign of a reversal. So the next day price was bullish, or the next week, this is I think a weekly chart, and then the week after that closed bearish. But what happened? Price did not close below the previous day open, and instead just closed under it, or sort of in between the body. And so what happened? Price started reversing at a bullish week, and so far it's been pretty bullish. All right, so just thought I should add that in there. Definitely look at my previous videos to further explain this method a little bit more, because it can be applied on the weekly as well. And I highly recommend you look at AMD/Power of 3 on YouTube, especially the video that I made on it. I think it was pretty good. Okay, so definitely check it out. Now, for this part of the section, I'm going to get into a few little more, I guess, advanced techniques, or some techniques that may be considered advanced, just to help you guys out finding your weekly and daily forecast. Okay, so just pay very close attention. I still think this part is pretty important. You don't have to watch this part if you don't want to, but I would highly suggest you watch it just to give you a little bit of an extra edge. Okay, so let's begin. Okay, so the first thing I would recommend is to watch my video on market structure shifts versus liquidity grabs. Very important video. Okay, so lows or highs that fail to break and form new structure can potentially be zones of liquidity. So for instance, here we have type 1 market structure marked out. So we go up, down, and then we tried going up, but this low right here failed to break structure. So what happened? Price came down, took out the liquidity here, right? And then finally started moving back up. Very important. So for some people, You might think that structure might be changing or structure might only be grabbing liquidity, right? It's very hard to tell. But if you watch my video, it kind of helps out figuring out some of those key differences. Okay, so definitely check it out. All right, so the next one, this is pretty famous and it's been catching along a lot. So it's SMT divergence. I personally do not use SMT divergence. I don't believe it to be necessary, but it seems that a lot of people do use it and it's been helping out many other traders. But like I said, personally, I don't use it, but I'll just go over it fairly briefly. So SMT divergence, or smart money technique divergence, is a concept introduced by ICT and involves identifying divergences between two correlated assets within the same time frame, which can signal potential reversals in the market. Key points of SMT divergence. Correlated assets. SMT divergence looks at two assets that are typically correlated, meaning they usually move in the same direction. Opposing structures. When these assets start to show opposing structures, such as one forming a lower low while the other fails to do so, it indicates a potential reversal. Potential, guys. Not always the same. Potential. Positive and negative correlation. This concept applies to both positively and negatively correlated assets. For example, if two positively correlated assets are moving lower, but one fails to make a lower low, it suggests weakness/strength in the market. Confirmation tool. SMT divergence can be used as a confirmation tool alongside other indicators to identify key reversal points. What I mean by indicators, guys, I don't actually mean like trading indicators. I mean like confluences, okay? So, some people use indicators as confluences. Just, I guess, a semantics kind of thing. But yeah, guys, you can use SMT divergence. There is actually a really good indicator from LuxAlgo. I'll link it down in the description below that you guys can check out specifically for SMT divergence. All right, so I'll leave it there for you guys. Next is fundamentals. Yes, I already went over this, but I thought I should go over it a little bit more. So in day trading, fundamentals refer to key information about a company or economic data that can affect a stock's or asset's price. Unlike technical analysis, which focuses on price patterns and trends, fundamental analysis looks at the underlying health and performance of an asset. This comes in really handy when you're indecisive on where the week might be headed. So this is just an example from Fastbull, which is really good for this stuff too. I definitely recommend you check them out. But yeah, I can give you like a little bit of a summary as to what's going on throughout the day or the week or whatever the case, right? So highly recommend it if you want a place to look for fundamentals on the asset that you're planning on trading. All right, so next is trend depth. So small retracements equals strong trend, deep retracements equals weak trend. So this isn't specifically directed towards any asset in particular. All assets can show these kinds of trend depths. It just depends on like what's going on or how much volume is being traded, so on and so forth. And generally, a strong trend shows very little retracement towards the 50% or even below it. Usually you'll see this though on like NAS 100 or sometimes gold, right? Not all the time, but I'm saying it does seem to appear there more. And a sign of a weaker trend, you'll usually see price dip below like the 50% of a Fibonacci level. So it's like usually somewhere around this area. Sometimes, it can be any level under the 50%. And sometimes, like I said, price can retrace on any level above the 50%. So just keep that in mind when trading, especially if you're looking at like a weekly forecast or a daily forecast, right? So if you notice that your trend has been fairly strong for the rest of the week, then you'll probably be able to say, hey, the fair value gap that's like above the 50% might be the one where price will probably tap into and not go further than that, something like that. So let's move on. All right, so the next thing is chart patterns. Yes, you can use chart patterns if done correctly. I only recommend you use them as an area of strong support and resistance, and if possible, combine them with some form of ICT or SMC or whatever you want, just something else. All right. So as you can see here, I have a little bit of a pattern, right? I have it marked up. I'm going to use, let's say, it's if I were to trade, right? It's if I were to trade this asset and I had marked up this line. Well, clearly I could say this area right here Could have been like some kind of order block, and I would have said, okay, price will not go further upward this order block, and because of the pattern that I'm seeing on the weekly time frame, I think we're pretty bearish, and price should just keep going bearish from here. But you can also trade in between your trend lines. So once price reaches a higher area like this, you can start looking for sells, right? Going all the way down to maybe this key level right here, right? Something like that. And then once price reaches that key level, you could say, okay, well, I'm gonna look to target maybe an order block somewhere up here. All right. And then you just enter a long position and then trade going up to this key point. Just something like that, just to give you an idea. It's not always this clean cut, but it is an idea, or a way that I used to trade before I started to really moving towards the ICT stuff or SMC stuff. And I'm only doing that because, well, because of what I'm teaching you guys. I've been giving more towards the SMC and ICT ideas. Okay, but yeah, just a thought. All right, and lastly, the pitchfork. So yes, Andrew's pitchfork is useful for finding a weekly bias because it provides a clear visual representation of the overall trend, direction, and potential price movements on a weekly time frame. Now, the reason why I'm emphasizing a weekly time frame more than a daily is because it seems to work better on the weekly. But yes, you can use this on a daily. Now, I have been getting into the Andrew's pitchfork a little bit more recently, so you might be seeing them on my weekly forecast, just because I want to try something a little different, not because what I'm doing doesn't work. I just like having different methods. That's all guys. I just like teaching people different things. So just real quick, if you're using the pitchfork just for setting your weekly or daily bias, you won't need to adjust it very often. But if it's part of an active trading strategy, you'll need to tweak it regularly, or even set up multiple pitchforks to stay aligned with market changes. Let me read one more time. Nah, I'm playing. I'm not gonna do that. But yeah, just make sure, guys, that if you are trading on like a lower time frame, you probably will have to readjust the pitchfork constantly. But that's one thing I don't recommend you use it for. Just use it for your weekly or daily bias. Okay. All right. So for the Q&A portion, must your weekly and daily bias align? Optimally, yes, but if you are experienced enough, you can trade against your weekly bias. I'd suggest going for smaller RRs and no more than one trade, as opposed to your usual style of trading. But it's always best to stick to your trading plan no matter what you see. Guys, please don't trade against the trend. I know that if you guys like to find trades at all moments in time, just stick to your trading plan. If it's part of your trading plan to trade against the week or the day, then fine. But if it's not, just don't do it. Okay, don't do it. But if you do end up doing it, just stick to smaller risk to rewards, and please try not to take more than one trade per day, or per possible retracement. All right, just put it that way. Is a weekly bias necessary? Yes and no. Some people can trade perfectly fine with it and some don't. It really depends on your personal experience and how much data you have collected through back testing or forward testing, or sometimes even both, that can give you the answer you're looking for. Now, guys, I would highly recommend you try getting a weekly bias first to see if that's what's the missing key, because I know some of you are wondering, why doesn't my daily bias hold up when I'm trading? Maybe you need to add a weekly bias to it, just as an extra confluence. All right, just some food for thought. What's the best method? So I know that a lot of people are wondering, what's the best method to find weekly bias? And the only way to truly know is by back testing, as different methods respond better to different traders. The best approach is to follow the overall market structure, type 1. So if there's anything that you guys do, or I recommend you do, is to follow type 1 structure always, and then try to find a method that revolves around the type 1 structure. Okay, always follow type 1 structure. And if you have any questions that I didn't address, please add them in the description, or send me a DM in the Discord, or post it in the Discord. All right, now let's move on. All right, so I know that a lot of you are probably wondering how to make a weekly or even daily forecast from scratch. So I'm actually just going to give you a way to do weekly forecasts, because it's just fairly simple. As for the daily stuff, I'm going to make a couple more videos specifically on different methods to find a daily or session bias, just because there's so many ways to do it. Okay, so for now, I'm just going to give you a couple of examples on how to find a weekly bias. All right, so first things first, we got to see what caused the trend to move upward, right? So we are on Ethereum USD. Now, as you can see here, we are going to mark up this area right here. Now, I don't typically trade Ethereum, but just for this example, we are going to mark up some of the things that I see here. So we had a rejection block here. Okay, let's see, we had a like a sort of a change of character there, I guess, sort of. And let's see here, looks like price might be reacting off of maybe an order block up here, possible order block. I would say, you know what, I'm gonna make this whole thing the order block. Let's see here. Okay, and we will also mark up this for value gap there, value gap there. All right, okay, so looks like type 1 structure is telling me, looks like we might be overall bearish. Okay, now when it comes to this part, I would say I wouldn't trade, just because I'm afraid that price might start reversing at some point. But if I were to trade, I would say price is just going to make some kind of retracement from this area right here, because it is tapping into for value gap and order block. So I'll say we'll look for sales and start targeting these points of interest here. And if price decides to break through, then it'll break through. Okay, so for now, my bias is bearish. Why? Because type 1 structure is bearish. Let me change the color of this. Type 1 structure is bearish. We have a bearish order block, a fair value gap. Price seems to be respecting it pretty well. It hasn't been able, it already tapped into it a couple of times and hasn't been able to break through it. So I would say overall my bias for the rest of the week is bearish. And by the way, guys, these highlighted gray areas represents a whole week, right? So this whole area is 1 week. The non-gray area is also weak. The gray area is also weak. So if you guys want this indicator, I'll link it in the description down below. All right, so for now, my bias is bearish, and as you can see, the bias was correct, right? So throughout the day, or throughout the next couple of days, you guys could have entered some bearish setups or some sells and just kept targeting these areas, right, until there was some kind of sign that says, hey, I'm done, I'm gonna move back up, or so on and so forth. All right, so let's move on to another example. Okay, so we are on S&P 500 futures. Okay, so any for value gaps on the daily? Yeah, actually, I see this right here, right? And you guys don't have to. You guys can start off any way you want. Just make sure that you are incorporating the things that I'm teaching. Okay, so price clearly reacted off of this area right here. You know what? I'm gonna make it easier because clearly we have failed breakup structure here, but I know why, because it tapped into an order block here. So we had a failed breakup structure, prices were tracing into this area, but it looks like it could be either one of these order blocks that it might be retracing into. So just for better clarification, let's see, I went up to the 3-day. I'll mark up this whole fair value gap. So we'll just use 3-day FEG, right? And let me see if I can find a better way of marking up the order block, just a more refined way. Yeah, it looks like, yeah, okay, so I think I'll actually use this order block right here. Yeah, we'll use this. We'll see what happens. So we'll use this 12-hour, and that's also another reason why you want to use a few different time frames, not too many, just to helps me refine them more precisely. That's all, just helps me refine more precisely where price might be headed. We'll go back to the daily. Okay, so we saw what caused price to move down, and it was this order block up here with this fair value gap. But what does type 1 structure say? So I don't really zoom out too much for my type 1 structure, although you can. Let's see, we got movement up, down. I would say this is more of a, there you go. And then we had fill structure. So now we're just waiting to see price is going to do. So the only thing telling me that we're going to be bearish is this field break of structure. But we have a fair value gap here, and then we have an order block here. Now, if you guys want, you can look for sell setups, but I wouldn't look for too many, and I wouldn't hold my RR too long, just because you're in already this fair value gap and you're near this 12-hour order block. So my forecast would be slightly bearish, but overall bullish. I am expecting this level to hold. So let's see what happens. Okay, so we already have price rejecting here, bullish. All right, looks like we might actually be heading back up. So look at this candle right here real quick. Strong wick, swept the liquidity here, tapped into this 3-day fair value gap once again, and now it looks like we might actually be going towards some external range liquidity. And the rest of the week, bam, hit external range liquidity. Right, pretty simple, nothing crazy, nothing too hard. I try to keep these things very simple for you guys. I try not to overcomplicate it for you, but you can use whatever method you want. Just make sure you're back testing it, make sure that you have collected enough data for it. Now I'm going to show you one more example, just because why not, right? So let's hop on to the next one. Okay, so for this example, we will be using Euro USD. Now I already have a few little things marked up here, but what can we see here? We can tell that price swept some liquidity and it has been consolidating, right? So very ugly price action. But with fundamentals, we can say, okay, price swept liquidity, right? From this high, it's been consolidating pretty badly. And let's just say, for the sake of this example, the fundamentals were saying, hey, we're going to be pretty bearish for these next upcoming days or the next day, whatever the case may be. Now we just need to look for something or confluences that says, yeah, we're probably going to start looking for some bearish setups and some bearish days. So this sweep right here is one of those confluences. Let's see, sweep, right? Consolidations are usually a sign that the trend is about to either reverse or expand, right? And in this case, we've been seeing some consolidation, sweep of liquidity, and fundamentals say we're going to head down. All right, perfect. So maybe, let's see here if I can find this. Okay, so even though my type 1 structure says, look, we are overall bullish, but we have been sort of seeing this consolidation and it's been accumulating pretty badly. We might have some kind of bearish momentum back down again to go back up. Now, I could be wrong about the overall structure being bullish, but what I could possibly be right is my type 2 structure being bearish. So what I'm thinking is type 2 structure being something like this, right, to go back up. Okay, so let's see what price does. Okay, bearish. Okay, I'm hoping that price will finally find some kind of barrier here and we'll say, you know what, it's time to go back up. Now this is already for the rest of the week. The week is done, right? It's done. But what happened? Price broke through it, didn't show any signs of reversal, and what happened throughout the rest of these next upcoming weeks? It became bearish, right? So I might have been right about my type 2 structure being bearish, but I could be wrong of my type 1 structure. This is a reality, guys. I showed you this example because you won't always be right by your weekly or daily forecast. It happens and it's completely normal. That's why we try doing the analysis part, both fundamental and technicals, to try to mitigate as much losses as possible. But you simply won't always catch them all. But that's also another reason why it's also important to have type 1 and type 2 structure, so that way you can at least catch some kind of profitable trade and not completely lose all of them. Because if I would have just said, okay, I'm just going to follow my type 1 structure, being overall bullish, I'm just going to look for bullish setups, I could have gotten wrecked. But by using my type 1 and type 2 structures, I expected the rest of the week, just the week, to be bearish and not completely bullish, right? So I said, okay, the rest of the week, it's going to be bearish. I'm going to look for bearish setups. Hence, I could have caught some bearish setups. But if I would have just stuck with, oh no, everything's bullish, I'm only going to look for buys, I'm either going to get wrecked or I'm not going to find a single trade and missed out on some good opportunities. right? So that's why it's very important to do your chart work, to back test, to look at all my videos, especially the intermediate to advanced market structure video, to mitigate these kinds of things. All right, so let's move on. Thank you so much for sticking to the end of this video. I really appreciate it. I hope you guys learned something. I hope that you can incorporate some of these things, and maybe it fills in some of those gaps that you might have had. Now, as always, you can contact me on social media, on Instagram, Twitter, by email, and joining the Discord. So please send me your questions, any ideas that you guys want me to cover, videos, whatever the case may be. Now, before leaving, I gotta leave you with a little bit of biblical wisdom. Yes, sir. So Proverbs 4:7, the beginning of wisdom is get wisdom, and with all you have gotten, get understanding. So I guess just a little quick breakdown is, when it's talking about getting wisdom, skillful and godly wisdom is the type of wisdom that it's talking about. For skillful and godly wisdom is the principal thing. You don't just want to get any type of wisdom, because you also might have some kind of bad influences that think is good wisdom, but it's really not, especially if it doesn't align with God's values, right? And with all you have gotten, get understanding, discernment, comprehension, and interpretation. You don't want to misinterpret the biblical text, as that could lead down to a whole bunch of other problems. But please look for discernment, look for comprehension, and correct interpretation. Now, with that being said, guys, thank you once again, and I will see you all in the next one. Peace.